All right, what is up, tycoons? What's up, traders? Super excited for today's video. Going to give you guys another TLT and market update. So we are going to go over the TLT current chart setup, give you guys an update on that cup and handle pattern that we had forming. We did get a breakout of that channel. Go ahead and give you guys a nice update on that. But before we do so, there's a lot of charts and, just really good and interesting data that I want to present to you guys. So we're going to hop straight into it. Smash that like button, subscribe to the channel if you guys are new. And the first one here that we're looking at, it's a little hard to see really and really understand, but I'm going to break it down for you guys. So what we're looking at is this is the October low, right? And so if October was the low, this 6-month rebound has been the weakest ever, guys. So, there's a lot of people saying that this could be another bear market rally and that we are going to revisit some of the October lows or potentially make new lows. And this is one of those bearish data sets that kind of shows you that. Now, this line right here in particular is going to be the average of all of these lines put together. But we can see here that the black line is actually our current S&P 500, okay? And we can see here that this is the lowest level, right, that it's been compared to all of these other rebounds that we had after a 6-month period after the stock market put in a bottom. So, just something interesting. It is a little bit more on the bearish data set here. And, just because this is the weakest rebound, it doesn't mean that we have to revisit lows. It could just be the fact that, we are actually seeing the weakest rebound ever from a stock market bottom. All right. Now, the next one that I want to look out, this is the market outlook in levered era with the pivot in a not pre-recession buy signal. Okay. And so the only time that the pivot was a buy signal was when there wasn't a recession coming in 1995. Now, the Fed pivot is something that a lot of people are talking about right now and something that people are really interested in. So, what we can see here, all right, is that the pivot is not really always a buy signal. Okay. In fact, oftentimes you don't get those pivots. Okay. And so the initial rate cuts are here, indicated by the green arrows, and you can see that we end up actually going down. And so these red shaded areas here, these are recessions, right? And so we see that we typically get a recession after the Fed pivot. Now, why would this happen? Well, the Fed isn't going to pivot and start cutting rates and stimulating the economy until things are broken. And so currently the Fed does not think things are broken, even with banks collapsing, whether it's Silvergate, whether it's Silicon Valley Bank, whether it's Credit Suisse. There is many banks and many things collapsing right now in the economy, but the Fed is still pumping up on the rates and increasing the rate hikes. So the pivot is not really a buy signal. The only time it was a buy signal is when there wasn't a recession coming in 1995. This is the only time that it was a buy signal. So that's something really interesting to keep in mind. All right, is we basically have the most predicted recession ever in front of us. And a lot of people say that, oh well, if everybody thinks a recession's coming, then we won't actually get the recession. But if you go back through time, okay, each recession and before the recessions, a lot of people were saying, hey, we're about to get a recession. We're about to get a recession. And so just because everyone's telling you that there's a recession doesn't mean that the recession won't come, because everybody's going to change their spending habits and, things like that. A lot of times they're saying it for good reasons. And the Fed pivot does not indicate a buy signal. People, I know there's tons of people, especially on YouTube, saying, oh, as soon as the Fed pivots, buy and go long. And that's not always a safe investment strategy. And the only time, again, that it was a buy signal is when there wasn't a recession in 1995. Now, the content provided on this YouTube channel is for informational and educational purposes only and isn't intended to be relied upon as legal, financial, or investment advice. Myself and any individuals that appear on this channel are not registered financial advisors or brokers. Trading in stocks, bonds, commodities, and crypto involve a significant risk of loss and is not suitable for all investors. So be sure to read through the full disclaimer. I'm not here to tell you guys to buy and sell something, but rather just give you guys some really good data that I think is interesting. Now, This is the S&P 500 earnings per share. And what we have are the three different cycles, right? So we have hiking cycles right here. And what's really interesting is that you can see that earnings per share, they do actually and can actually rise during hiking cycles. And then this is during a pausing cycle right here. And you can see that they also are rising in a pausing cycle. And look at where they're actually mostly negative, right? And where you see earnings per share actually going is in those cutting cycles, guys. And the reason being is because of what I just mentioned before. The Fed isn't going to be cutting rates until things are broken in the economy, right? And, that's something that people really have to keep an eye on, right? And the reason that we're seeing these big moves down after a Fed pivot is because things are broken and we have a recession coming, or we're in a recession. And that's why you get these recessionary periods. And in these recessions, you're going to see company earnings go down and you're going to see their EPS go down. So this is really just another good data set here that shows, like, even in these hiking cycles, even in these pausing cycles, we can see the earnings go up, EPS go up, but it's actually once they start cutting that's generally when you start to see EPS go down. All right. So a lot of people are saying the Fed is about to start cutting rates very soon. And if that happens, this is a really good data set right here to show you guys that may be something to be a little bit worried about, and maybe not to be so overly bullish on. Now, when it comes to TLT, this is the daily chart that we're looking at. So each candlestick represents a day. This is that cup and handle pattern that I went over in my last video, guys. So we had the cup right here, we had our handle, and the handle was actually, to be more precise, was going to be this bearish channel that we had. And so in a textbook case, what you're looking for is a look above, a breakout, retest, and push higher. Now we have this gap up here. That's what this box is right here. We have a daily gap up on TLT to fill to about 111, and we actually just created two small gaps up as well. If you take a look right here and you take a look right here as well, we have gaps in between these candlesticks. These gaps, they tend to fill about 90% of the time. And if you combine the fact that we have three gaps to the upside and three gaps to the downside, things aren't so clear on where direction could go. Okay. So the way that this inverse, or not inverse, but the way that this cup and handle can work out, right, is this would be textbook if we get a breakout, retest, and push higher and come up to that 111, 112 region. 109.69 is going to be a major resistance level we haven't been able to get above. That's our 61.8% retracement of this last leg down that we made. And it's still proving to be a super tough resistance area, guys. We do have the possibility of forming a triple top if we do rally up to this area, but aren't able to break out past 109.69. Then we could see a triple top. Last time we had a double top, we had a couple sell signals that form, right? So here we had the double top indicated by those two arrows. We also had a rising wedge, and we got a MACD sell signal. So in my last video on TLT, we had some question marks here because we were wondering, what was TLT going to do? Was it going to curl to the upside, give us that buy signal, and, potentially fill that gap? Well, look at what it just did, guys. It's flashing a sell signal right now. Okay, we actually just got a crossover to the downside. And each time we've had a downside crossover on TLT, it's been a very good indicator. And we've seen a, significant move down of about 5 to 10 points on TLT. Now it works to the upside as well as an entry signal. When you see the red line cross above, we ended up getting a nice push to the upside. And again, over here, we had that MACD exit signal. And here we are again, guys. We're actually curling back down to the downside. So there is one kind of last chance. All right. And so if we take a look, we have this bullish divergence. So if you're not familiar with bullish divergence, over here we had a low and then a lower low, right? Indicated by these two circles. So, we're clearly going lower in the price of TLT, but here we actually had a low and then a higher low on the relative strength index. So we were increasing in relative strength while the price of, TLT was going down. And in that case, it's known as a bullish divergence. And look at what we're doing right now, guys. We're actually testing that bullish divergence trend line. So if we can bounce off of here, all right, that would also coincide with a bounce off of the cup and handle channel. All right. So, it's not you don't have to make any hasty decisions right now. You don't have to rush into anything and wait for things to become a little more clear, right? We could end up getting a look above and fail and head back down towards the bottom of this range. That's going to be a bearish signal because right now, currently, bulls are fully presented the opportunity to really push TLT higher. We had the cup and handle breakout. We're getting a break and retest right now. And if we come back down into the range of this channel, that's going to be bearish because it's going to show that bulls did not take advantage of the opportunity. Rather, that bears are still in control and sellers are in control, pushing price lower. And most likely, we're going to start filling the gaps down that we have. We have one here at about 103. We have another at 100. And we also have a large gap down as well to about 95. So that's something that I'm going to be paying attention to. If we end up breaking through this bullish divergence trend line, then that's most likely when we're going to start seeing some, if not all, of these gaps fill down. Now, 102.88 is going to be a really big support level, and we could end up finding support there. 108, 102.88, 106.29, and 109.69 are really my big major levels that I've been watching really since before 2023 even started, guys. I've been watching these same levels for the past 4 or 5 months on TLT. They've been very well respected. And so what I'm going to be looking for is to see, is this a false signal right here? And are we going to see this curl back up? Are we going to bounce off of this bullish divergence? Are we going to bounce off of our trend line right here, our initial cup and handle channel that we had here? Or is this going to continue to, go down lower? Are we going to break this bullish divergence trend line? And are we going to potentially fill some of these gaps down that we have on TLT? These are the main things that I'm watching when it comes to the daily time frame. And I really like paying attention to some of the larger time frames, such as the daily and the weekly and things like that, because it gives you a little bit more of a macro perspective versus, just specifically day trading and smaller time frame levels. Now I look a lot at the smaller time frames, okay, and I trade TLT not every single day, not every single week, but I do trade it frequently, right? If we take a look, this is actually from Friday. I got 61.9% day trade, all right, and this is on a single position that I opened and closed on the same day. These are some other profits from some of the Discord members this week, right? We can see 144% gain, 77% gain, at a 56% gain, 64% of the entire account right here. And one of our new members that actually just joined about a week or two ago, guys, he made $379,000 on a single day trade. This is real money right here. Okay. It was a 129% trade in one single day. And this is through the power of options, guys. And options, once you learn them, you can really create, really big gains. It's it's not uncommon at all for us to really get 100% on, a day trade or a swing trade when it comes to options. It is very risky, but if you guys do want to join the Discord, okay, the link is in the description below. If you use code Zachley2, that's all lowercase ZACHLY and then the number 2. You guys can get a discount on your membership. That'll get you 50% off. It only works for April though. All right. That coupon code will be expiring in April. So yeah, I'd love to have you guys, join the community. As I mentioned, this is, one of our new members right here. He really doesn't even know much about trading or technical analysis, but he's learning and we're trying to help mentor him. And it's very beginner friendly. We're here to help you guys and help teach you some things. Not really just we're not just trying to, it's much more than some buy and sell alert room. Okay, there's a lot more going on in there besides that. Now anyways, when we come to some more things in the economic outlook, all right, such as the leading economic indicators signaling 2023 recession, what we see here, all right, is if we take a look, okay, this chart right here, all right, this is where we're at right now. This is extremely low, and this has pretty much been in a recession every time, all right, that we have dropped to this current level. All right, this is the Conference Board leading economic indicators from 1960 to the current, and this is the monthly year. Now, what we can see, all right, is that once this drops, this indicates a soft landing. So when it drops to this green area right here, that's what we're seeing. Okay, so that's the soft landing territory. And then over here, this red line is recession. All right, and so this is, recession territory. And I spoke in a few slides ago about recessions and earnings per share, and the Fed cutting. All right, and they typically will cut rates because things are breaking in the economy, and things breaking in the economy oftentimes means we're in a recession or heading to a recession, and you're going to see earnings per share typically decline in a recession. So keep this stuff in mind. All right, if we have a look at the credit outlook, all right, what we're seeing here is that the lending standards suggest a recession. All right, as loan demand is actually going down. So we're seeing this chart go up, which is not good, and we're seeing this chart go down, which is not good either. So what we have here in the black line here is going to be loans to large and middle market firms with loans to small firms. We can see that this loan demand is going down right here. But the lending standards are actually tightening and going up right now. So, these two things are moving in the opposite directions that we want them to. All right. If we take a look at 08 and 09, we look at the great financial crisis right here. All right. This was very high, very elevated. And meanwhile, it was very low. All right. In these levels over here. All right around that 0809 time period. You can take a look at 2000, right? The 2000, the dot-com bubble, right? And we see the same thing where, loan demand is low and then the lending standards are actually high. And that's, the current environment that we're in right now. So that kind of suggests a recession as well. Now, this is the S&P 500 post-bottom 6-month analysis. And this is kind of just going over, some of the charts that I went over in the very beginning. All right, but if you take a look at 1974, the S&P 500 change in 6 months after the bottom was about 34%. In 1982, it was about 42%. 1987, it was 13%. 1990, we had 27%. 1998, 32.79. 2002, it was about 12.83%. In 2009, it was 47.5%. 2018, it was 24.10%, and in 2020, it was 52%. Now the Fed funds rate, we also have the Fed funds change in a 6 months time period, and these are in basis points. So in 1974, it went down 375 basis points. That's about 3.75. 1982 went down 250. 1987 went up 30. And then in 1990 went down 200, 1998 went down 75, 2002 went down 50, and the following years after those were all zero. And we can take a look here, and they talk about the 10 2-year spread 6 months later, and this is speaking on the 10-year 2-year treasury yield. And then we have the Fed fund rate FFR and the 2-year treasury yield, and this is also 6 months later as well. And it's just some interesting data points for you guys to use and think about, and help really just take in some of this data and use it to inform some decisions before you make them, and start thinking about things before you just go blindly throwing all your money into something. Right now, these are seasonally adjusted initial claims, and speaking of the jobs, and so what you see here is that this thing typically spikes really, really quickly whenever it goes up. All right, we see a big spike, and we see big spikes very quickly, and then it kind of goes down gradually, right? So it falls down slower, but it spikes immediately, and it spikes very quickly. And a lot of people are thinking that this is going to be a big thing that happens in 2023. The job market has remained pretty strong, and that's actually been a reason that the Fed has continued to hike rates. But a lot of people are saying that there's just going to be 1 month, right? One report, two maybe, where all of a sudden people are like, hold on, how many people just lost their jobs? And that's kind of where the mood is, right? Is it's not going to be something where, gradually we're just seeing slow increases every single month in like jobless claims, initial jobless claims. Rather, that it's going to be something that comes out of nowhere, and it may not come out of nowhere as a lot of people are kind of expecting it, But all of a sudden we're going to look and we're going to say, holy crap, a lot of people just lost their jobs right now. And that's something that's, bad news is eventually going to become bad news again, guys. Right now, bad news has been good news. And the whole reason being is because the Fed, kind of controls the market. And the Fed narrative right now is, hey, we need bad economic data news. So that way we'll be less aggressive with our rate hikes. And the market has been taking bad news as good news for, roughly the past year, throughout 22 as that bear market really developed and went on. But as I mentioned, eventually bad news will become bad news again, guys. And, you kind of have to prepare yourself for that. The next slide we're going to take a look here is the S&P 500 down basically 19% or more from its all-time highs. And then we have the peak and the low date. All right, and then we have the 2-year treasury yield here, the peak date, and then the number of weeks the 2-year peak led the S&P 500 low. All right, and so what we can see here is back in the 60s and 61, all right, we had a 23-week time period. Okay, so about 23 weeks, that the 2-year hit its peak. So the peak yield on the 2-year was 3.28%. All right, and that was January 16th of 1962. And then we can see here that the S&P 500, its low date was actually in summer of 1962. So it was about 5 months later. Now, if you move forward, 1966, all right, the 2-year peaked out at 5.94%. And then it only took about 2 weeks for the S&P 500 to hit its bottom. Okay. And then over here we have 1968. All right, we can see it took 26 weeks once the 2-year treasury peaked. In 1973, it took about 6 weeks for the S&P 500 to bottom. And then after that, in 1980, which is around that Paul Volcker era, that took 48 weeks. In 1987, it took 7 weeks. In 1990, it took 81 weeks. And then in 98, what we have there is about 71 weeks. In 2000, famous dot-com bubble. Okay, that was 125 weeks. And then 2018, it took 141 weeks. 2018 took 7 weeks. 2020 took 71 weeks. And then in 2022, that's where we're currently at. We're wondering how many weeks is it going to take, right? And so a lot of people think that the 2-year treasury has peaked, did peak here recently. It definitely did fall a lot, in some of the more recent time frames. But the median right now is 37 weeks, which is over half a year. And so, if you think about it that way, all right, then one way to look at it is saying, hey, well, the S&P 500 bottom date could potentially be 37 weeks from the peak of the 2-year treasury. Now, the data set is pretty wide, so the median is not necessarily the best. As you look, some of these are extremely low at 2, 6, and 7. And meanwhile, some are in, 3 digits at 125 and 141. So it's not the best data set when it comes to trying to time the market, but timing the market has never really been an effective strategy, and time in the market always beats timing the market. All right, so that's something to keep in mind. But yeah, so I would pay attention to the 2-year treasury yield. We're going to see, did that thing actually peak? A lot of people think it has peaked and it's going to, continue a little bit more of its downtrend. But we'll see, right? Nothing is guaranteed in the future. So that's something to pay attention to and keep an eye on. Now, equity ETFs took in a measly $27 billion in Q1. Now, listen to that, guys. A measly $27 billion. Isn't that funny, huh? This is their lowest cash haul since COVID, and despite a solid 7.5% gain for the S&P 500. Meanwhile, Treasury ETFs took in 40 billion, one of their best quarters ever, and have now taken in an absurd 166 billion in the past 5 quarters. Now, my kind of personal thesis kind of more aligns to what some of this data is saying here. I think that bonds are really attractive right now with how high the Fed fund rate went and the rate and, essentially the pace at which they fell. Now, does that mean that there's, not risks involved with that? And does it mean that bond ETFs can't go lower? No, it doesn't mean that, right? That can definitely happen. But, when I start thinking about, okay, well, if we look at the data and we see that historically the Fed pivot, unless we don't get a recession after the Fed pivot, and typically the Fed only pivots when we're about to go in a recession or in a recession, then that really hasn't been a good buying opportunity for stocks, and we've actually seen stocks go lower. But you know what does go up, all right, is the price of bonds. And the way it works is simply just from the mechanics of the bond market, right? As yields go up, as rates go up, bond prices go down. And as bond prices go up, rates and yields are going down. So if the treasury yield is going to be impacted by the Fed fund rate and the Fed does start cutting rates, then there is that potential that that relationship is going to cause bond prices to go back up. So some of the things that I'm looking at obviously are TLT, but I'm also looking at TMF, which is extremely risky. It is a leveraged ETF. It's a 3x leveraged bond ETF. But you know, that could be a good instrument to look at if you are bullish on the bond market and think that you know yields and rates are going to go down. That's one way that you could look at playing it. So hopefully you enjoyed this video. If you did, smash that like button, subscribe to the channel. I got another TLT video coming here soon. I've actually got about 3 videos worth of just like all types of really different data and charts. So I'm going to try not to make one giant long video an hour long and kind of just bust them down into a few videos over the next week. So make sure to stay tuned for those. Those will be coming soon. I'll probably drop one maybe on Monday or Tuesday and then crank out another one on Thursday or Friday.